Good afternoon, everyone, and welcome to our webinar this afternoon. Thank you for joining us. We all know that the budget speech isn't just about tax rates and revenue figures. It sets the economic tone for the year ahead in South Africa, and it also reflects government's priorities and its commitments to growth and also to stability. So today we are fortunate enough to be joined by an exceptional panel of experts who will unpack the key announcements, and they will help us understand not only what was said, but also what it truly means for you, for your clients, and for estate planning strategies going forward. So just to briefly introduce our panelists for this afternoon, we are joined by Dr. Candice Reinders. She's an attorney at PH Attorneys. She's a director and also the Free State head of our commercial practice group. We're also joined by Francois Fouchier, which is a director at PH Consult, and then also Tanya Strauss, director, PH Tax and Accounting. Before we begin, just a few quick house rules from our side. Kindly note that your mics are muted. You will, however, be welcome to ask any questions in a Q&A throughout the session. And if there is any time at the end, we will attempt to answer some of them as time allows, obviously. But you're also more than welcome to send us any emails. You can find our contact details on our website, and we will also gladly respond to them. So without wasting any further time, Francois, I think it's a good idea for me to throw the first question to your side. Looking beyond the headlines, what do you think the real impact of this budget will be for taxpayers in South Africa?
Okay, we certainly view this as a very positive budget. I think it's been really well received by the market. And to be honest, I think the increase in tax deductions and thresholds and the further increase in the discretionary offshore allowances has really provided a breath of fresh air compared to previous years' budgets. So I think it promotes savings, and it creates a positive sentiment for taxpayers and investors alike. And I think with it, it squarely brings estate and tax planning and structuring, into focus. So I think it presents opportunities for taxpayers and investors, but I think with that, I think proper planning and structuring is required to make sure that we can tap into the benefits.
Yeah, it's indeed positive, Francois. I think one of the important key announcements also this year, specifically for individuals, was the adjustment to the personal income tax bracket after 2 years of the so-called bracket creep. Many people are wondering whether this will translate into any meaningful relief. So Candice, with the bracket creep finally lifted after 2 years by adjusting the personal income tax with inflation, does this offer any relief to taxpayers?
Yeah, Andre, it's definitely a welcome relief, and it will help toward easing pressure on taxpayers. That being said, there's still 40% of revenue collection that is allocated to personal income tax, and roughly 60% of that collected revenue comes from high income earners. So while we need to pay our taxes, it's not a new concept and it's a worldwide standard. The reliance on high income earners is quite noticeable. So there is still an emphasis on the government taxing high net worth individuals. But be that as it may, any relief from the bracket creep, even if it is modest, does have a meaningful effect on taxpayers. And Tanya can jump in here. I know she did a calculation, but just over those 2 years, the impact that the bracket creep had on the average household's income did have an impact. So it is going to be a good relief for the taxpayers.
Yes. So it's important to realize the stagnant bracket for the past 3 years would have effectively increased the average South African family's tax from roughly 24% of income to 26%. So this inflation increase merely keeps it at that 26% level, but at least the bleeding has been stopped for now.
Well, Tanya, I think what is clear is that the relief is real once you factor in inflation and the rising costs over the past few years. And that naturally brings us to the next question, and it's perhaps a very important question as well, because beyond what government adjusts, what can individuals actually control? Candace, looking at from a practical perspective, what practical planning options are available to clients to protect their income?
Well, one of the most effective tools remains retirement funding. So maximizing contributions to retirement annuities, pension funds, provident funds can reduce the taxable income of a taxpayer while simultaneously building long-term wealth. And we have also seen that the recent increase in the allowable annual contributions limit from 350,000 Rand a year to 450,000 Rand, which gives taxpayers additional room to structure their contributions effectively and to maximize deductions. But then from a high income earners perspective, you have remuneration structuring that you can consider, as well as rediverting income into a different vehicle. So we don't really have a shortage of solutions, but we need to remember that when we are going to consider these types of restructuring of income, that it has to be done correctly. So just by way of an example, if a taxpayer were to receive dividends that SARS deems to have come or been by virtue of their employment, then those dividends will not be subject to the dividends tax rate of 20%, but would actually be included in the taxpayer's gross income and then taxed on their marginal rates. The same thing when an employee is going to receive or acquire shares by virtue of their employment, either in the employer company or through any other person by arrangement with the employer. If the shares that the employee receives is considered to be a restricted equity instrument, then ultimately the difference between the value of the shares the moment that those shares vest in the name of the employee, which in other words just translates to that share becoming unrestricted. So the difference between the value of the shares on the date of vesting versus what the employee actually paid to acquire those shares would also be considered to be income in nature or as a special inclusion, and then included in the gross income of the taxpayer. The taxpayer would then unfortunately have to pay out of pocket on that value, because they've never received anything from the employer to actually pay for that taxable income. So if you don't structure correctly, then there could be adverse tax consequences for the client. The same with redirecting income to different vehicles like a company or trust. If that company or trust is considered to be a personal service provider, then the employer will still be required to withhold employees' tax from any remuneration or compensation that is paid to that personal service provider, and there could be limitations on the deductions that are allowable. So proactive planning, regular tax reviews, thoughtful restructuring, all of this needs to be taken into account in order to ensure that the clients manage their exposure in this progressive tax system.
And as I think just listening to you, it strikes me that one should also keep the ultimate withdrawal of the income from those investments in mind in future. So obviously, when you cash in on discretionary investments or you make withdrawals from retirement funds, that obviously has to be taxed. And I think, just as for PH, we always advise our clients and their advisors to plan with the end in mind, and that is that someday you want to access those provisions that you've put away in terms of savings. And I think one should just not lose sight of the fact of how that will be taxed one day, and that should be part of and considered as part of the strategy.
100%, Francois. You definitely have to keep the end in mind. It's one thing to structure correctly, but it's a completely different thing to be running around at the end trying to ensure that the withdrawals and the ultimate structure is tax efficient. So definitely.
I'm sure that will give our audience something to think about and potentially act on. Tanya, let's take a step back and sort of look at the broader picture. Beyond the specific tax changes and planning opportunities, many people are asking whether the budget signals any shifts in government's overall approach. So from your perspective, have you picked up on any high-level policy shift, and how will this negatively or then positively impact taxpayers and tax practitioners as well?
Yes, and so there appears to be a bit of a policy shift. So for the last couple of years, many legislation changes pointed to the fact that Treasury was trying to get as many South Africans as possible registered for tax. It looks like they've realized there are just too many small guys now, which becomes an administrative burden and very difficult to modernize. So the higher collection in the previous financial year has given them the opportunity now to make a bit of a U-turn on this. As Candice mentioned, the personal tax brackets have been adjusted for inflation. So the absence of these increases in previous years effectively translated into a much wider inclusion of taxpayers at the lower end of the tax scales for 3 years in a row. So at least this has been stopped. But another major example of this shift is mandatory VAT registration increase from 1 million to 2.3 million effective 1st of April 2026. This is the first increase since 2009. So it's large, but they've effectively given us exactly the inflation increases that we've lost for the past 17 years. This is, of course, great news for small businesses, and will definitely lead to fewer VAT registrations and submissions, as well as a couple of deregistrations. It's important that business owners just consult us before they deregister so that they fully understand all the impacts. Some companies actually benefit significantly from input VAT, so we just need to be careful. And then provisional taxpayers have also received an administrative relief. Anyone with a taxable income below 1.8 million can now use historical assessments to make their provisional tax payments. This was previously only 1 million, so that will help a lot. But yes, the focus is definitely continuing to shift towards the higher income taxpayers. But there are many amendments that were at least given through this year, which can be utilized to structure tax affairs effectively. The items with the biggest estate planning impact will probably be donation exemption increase from 100,000 to 150,000, the single discretionary allowance increase from 1 million to 2 million, and then also a couple of capital gains tax exclusions that were increased, but we can cover these in a bit more detail in our local and offshore estate planning session of this discussion.
Well, Tanya, it certainly gives us a sense of the direction in which policy and enforcement may be heading. And in addition to that, we all know that the real impact of the budget is not necessarily always in the headline tax rates, but sometimes in the smaller, more technical changes that can have a significant effect over time. And I want to bring you in again on this one, Tanya. Can you give us any subtle under the radar legislation proposals where SARS is effectively increasing our income tax or closing tax leakages without necessarily increasing the tax rates?
Yes, there are still a couple. So firstly, the estate duty abatement, for one, has still not been amended. It's still sitting at that 3.5 million since 2007. If this was inflation adjusted, we would have been above 20 million per individual by now. So this appears to be a definite policy intent to tax the transfer of wealth at death for more South Africans. Also, one of the February 2025 budget proposals will start impacting us from this week, the 1st of March 2026. That is now the wider application of Section 20A assessed loss ring fencing. So previously, individuals had to be at the maximum marginal rate for ring fencing of certain trade losses to apply. The individual now only needs to be at 39% of tax for ring fencing to apply. So I believe SARS is concerned about the misuse of losses in general. So they're trying to widen this restriction. And the last thing that comes to mind is also, you'll remember one of Treasury's proposals last year was to delete the Section 10(1) GC exemption that South African tax residents currently receive from foreign retirement benefits. So if you have someone that worked abroad they came back to South Africa and retired in South Africa, their foreign retirement benefits are currently exempt from tax in South Africa. So Treasury was worried that this could lead to double non-taxation. The good news is that during last year, there were many stakeholder comments, and they've partially accepted those stakeholder comments to keep the exemption in place as an interim measure and to then discuss it further during the next 3 years. But that's one to look out for.
Tanya, it shows again that the detail really do matter. Francois, I want to move to an area that has received a lot of international attention and is increasingly relevant in a South African context as well. We've heard a great deal about the global minimum tax and the broader global tax reform agenda, and many clients are still unsure about what it actually means, in practice. So turning to this topic, the global minimum tax, or Pillar 2, has been widely discussed. Could you briefly explain what it entails and, which taxpayers or structures are most likely to be affected?
Yeah, Andre, we've seen that the global minimum tax rate will be adopted in South Africa going forward. But I think one should just understand that it applies to multinational group of companies, and it effectively introduces a minimum tax rate of 15% on multinationals in each and every country where they operate. But I guess the good news for the attendees on this webinar is that it's got a minimum threshold of 750 million euros per annum, so it doesn't apply below that. So I think it wouldn't affect SMEs and individual taxpayers. So I wouldn't be too concerned about it. But I think what is interesting is, we're following suit. I mean, this has been implemented internationally, and we're now following suit in South Africa. So I think it tells us, that we are following international trends, and that also helps us, in terms of strategic planning and anticipating legislative changes, as we can take a lead on, from what is happening in the international space.
Yes, I can maybe also just add to that. So Treasury initially forecasted that South Africa would receive roughly 8 billion revenue from this global minimum tax, but the estimate has recently been revised downwards to 2 billion. So the expectations are not nearly as major as initially projected by them. The South African Institute of Tax has been pushing to rather look to a digital service tax. This has successfully been implemented by many countries, and it's basically a tariff on large digital companies. In SITE's opinion, this type of tax is likely to be far more beneficial to South Africa than a global minimum tax.
Thanks, Tanya, for your contributions there as well. Francois, to take the discussion offshore, there has been a lot of focus on offshore planning by South Africans over the last couple of years, which is always a key concern for many, as it seems very complicated, and it can be if you don't have the expert advisors to assist with that. There were some notable developments this year. We have seen an increase in the single discretionary offshore allowance for individuals, which you also alluded to earlier, which is great news. But at the very same time, crypto assets are now fully subject to exchange control. What impact will these changes have on offshore structuring for South Africans?
The increase in the single discretionary allowance will allow families to increase the offshore exposure quite rapidly, and even more easily, because obviously you don't need tax clearance certificates to avail yourself of the discretionary allowance. So I think families would really increase their offshore exposure and the ownership and the diversification of the portfolios to offshore quite rapidly. And I think to a large extent, that the genie is out of the bottle for South African investors. I think we all realize that, we need to diversify our portfolios. So I think what investors need to take into consideration is that with this relaxation and the increase of the discretionary allowance, you may actually end up reaching the tax thresholds for CITES tax or death duties in other jurisdictions quite soon. And I think you may also end up with a substantial offshore estate. And I think one should take that into consideration, and I think there's a lot of excitement. We've also experiencing a stronger rand in this year. And I think clients should just keep the planning in mind. So I think there's often a drive to make use of a stronger rand and to quickly get access to the diversification of portfolios. But we should not let the planning stay behind. So I'm thinking about things like international walls. So all of a sudden you will have substantial assets in other jurisdictions, and we must just make sure that we cover that in terms of the wall planning as well. And then I think South Africans have been tapping into the crypto investment space, but we must keep in mind that crypto investments and assets are now squarely within the ambit of the exchange control regulations. So they must also just keep in mind that when they invest in these crypto assets, it may be that you're already utilizing your discretionary allowance. So I think although there's a lot of positive, and it's a positive sentiment for investors, I think we should just not make sure that the planning shouldn't fall too far behind.
Yeah, sorry, Francois, just to come in there. Also, another interesting development with moving offshore or your funds offshore is the proviso to the spousal donation exemption, where now where spouses used to rely on the fact that donations between them were exempt from donations tax. Now that will not necessarily apply if one spouse is a non-resident and you have a resident spouse making that donation offshore, then that exemption won't apply anymore.
Candice, I think it underscores the fact that SARS and Treasury and the Surveillance Department are also wide awake, and they see trends developing and forming. So it just illustrates the fact that one should get updated advice, and a strategy that may have worked last year may not be viable anymore because due to changes. So I think it's important for clients to stay close to their advisors and to make sure that they get updated advice.
Thank you, Francois. I think one thing that it definitely highlights is that there's indeed a lot of opportunities, but one must also keep in mind that there's a lot of risks, and you need to navigate this. And in order to do that, as you alluded to, one need the expert advice and the experts to guide you through that as well, to ensure that you implement effective structures and that you take your funds offshore in the most tax efficient and obviously within the ambit of the law. Staying with the theme of offshore structuring, one trend of many we are noticing is the increase in distributions from South African trust to offshore trust beneficiaries. Now, this creates both opportunities but also risks, especially if not structured correctly. So from your perspective, what are the most important tax considerations that practitioners and individuals and trust should keep in mind when implementing these types of structures, and specifically when you distribute from a South African trust to an offshore trust beneficiary?
Yeah, Andre, I think it's quite a natural progression for clients to integrate their offshore trust and local structures as far as possible and to be as efficient as possible. But I think when we consider distributions from local trusts to offshore trusts, there are actually a number of things to be aware of. I think we've seen quite an uptake, on that strategy by South African clients. But I think one should realize that you still need Reserve Bank approval for South African trust to make a distribution to an offshore trust beneficiary, and there may be conditions attached to that approval. So it's not just a sort of a blanket process where you could just go ahead and do it. You still need Reserve Bank approval. And then I think one should just be aware of the tax consequences. So you can distribute cash from a South African trust to an offshore trust beneficiary. Obviously, you can't transfer movable property or shares or other kind of assets. And that means that you'd have to liquidate those assets. And since you are distributing to a non-resident beneficiary, you won't be able to pass on the capital gains using the conduit principle to a beneficiary who will be taxed at a lower rate. So essentially, that will result in a capital gains tax liability. It will be taxed at 36% in the hands of the trust. And then more importantly, I think there's a little bit of uncertainty on where the attribution rules will apply. when that distribution is made from the local trust to the offshore trust. And I think one should be aware of those risks. And I think one should consult your tax advisor to consider some tax mitigation strategies, at least until we get some more clarity on how that is viewed by SARS. So I think it's definitely something that clients should consider. I think it makes sense in terms of the overall estate planning strategy, but there are some tax risks to consider, and I think clients would be well advised to consult the tax advisors in that regard.
Thanks, Francois. That gives us a clear overview of some of the important offshore considerations in that regard to keep in mind. Candace, to bring the conversation closer to home, locally, many clients are also looking at ways to protect their legacy and to ensure continuity of their business or their key assets, specifically for the future generations. From that perspective, how can corporatization be used as a strategic tool to achieve these goals?
Yeah, Francois. So, sorry, Andre. Corporatization can definitely be used to maximize on profits and to preserve wealth. And it's always funny in February. I tend to get a lot of instructions to do the corporate structuring because a lot of clients get nervous about whether SARS or the government is going to attack the corporate rollover relief that we have in our tax legislation. But we haven't seen much attack on those provisions, and we still will benefit from the rollover reliefs. The only one that we have seen recently is that the corporate rollover reliefs are going to not really be applicable anymore to collective investment schemes. But other than that, we still enjoy the corporate rollover relief, where we can transfer wealth or assets in a tax efficient way from a taxpayer personal estate into a corporate estate. Now, that being said, it's always best to structure a corporate estate correctly from the beginning. So early planning allows for ownership, control, and succession goals to be aligned in a tax efficient way while avoiding unnecessary tax complications later on. Unfortunately, that's not always the case, and many clients or taxpayers, when they do decide to restructure, then they already hold significant historic value in their personal estate. And unfortunately, the reality is historic value cannot simply be disregarded or erased. It's a fundamental principle that the historic value cannot be transferred without proper compensation or at least adequate consideration. So the focus in these types of situations then shifts from moving everything into a corporate estate to actually managing that historic value properly. So we therefore have to ensure that any movement of value between connected persons or in asset for share transactions, that they are done at fair market value. Otherwise, there's going to be a taxable event. So while historic value in itself is, for the most part, unavoidable, future growth can always be redirected and preserved through other vehicles like a trust. So when considering corporatization, it is a powerful tool, and it must be implemented carefully to ensure that historic value is not prejudiced and future growth is structured in a sustainable way. But like Francois also mentioned earlier, you also have to keep the end in mind. It's one thing to do a corporate structure, and it's another at the end of the day when you're sitting with your estate duty bill and you have got no liquidity to actually pay your estate duty. So all of this needs to be taken into account when deciding what you're going to put in a corporate structure, and ultimately at the end of the day, how you're going to foot the estate duty bill.
Candace, what you highlighted is that the correct structuring can play a pivotal role in a client's protection of their legacy. And I want us to stay on that topic. Trusts continue to be one of the most widely used tools for both asset protection and also for succession planning, estate planning. What key factors should clients and advisors also consider when establishing trust, whether it's for themselves or the clients, and what risks or common pitfalls should they be mindful of to ensure that the structure, remains effective and compliant, especially when there's trusts involved?
Yeah, Andre, like you said, trusts are powerful vehicles. They help with asset preservation, like you said, creditor protection, generational wealth planning, and despite the fact that they've received some scrutiny over the past few years, most advisors will still say that it's still a useful tool. For me, the most critical thing when it comes to trust and deciding whether to introduce a trust into your estate planning is to consider how you're going to fund that trust, and that's a very critical component, aside from the administration of the trust once it's been established. So when you look at a trust or establishing a trust, it is a natural requirement that there needs to be some form of disposal or divestiture of property from the founder to the trusts in favor of the beneficiaries. And this can be done in many ways, but typically either done through disposals, loans, or donations, each with their own unique tax consequences. So loans from a founder to a trust are commonly used, but I think everyone is now aware of the term Section 7C and what it all entails. So when you are making a loan to a trust, we obviously need to make sure that that loan carries at least the official interest rate, failing which, if you have a loan that is low interest or interest free, then the difference between the official interest rate and what it is that the interest you're actually levying on that loan could fall within the ambit of donations tax, and then you're going to have to pay donations tax on not levying interest. Another form of funding is through a donation. This is also a popular method used. Generally, what would happen is a founder would use their annual donation exemption, which luckily we've also had an increase there from 100,000 to 150,000, the annual donation exemption. And this is going to provide some welcome relief to taxpayers. However, what is important to remember is instances where donations are made to a trust, and even if you do pay donations tax, then clients tend to think that they've paid their tax and the matter is settled. But unfortunately, we do have the attribution rules. Francois did allude to them a little bit earlier. And if any income is generated from donation, settlement, or any other distribution that is made to a trust, then that income, in terms of the anti-avoidance provisions contained in Section 7, can actually be attributed back to the donor and taxed in the hands of the donor. So, some examples where these rules will apply is if a trust receives or generates income as a result of one consequence of a donation, and it decides in that same year it's going to distribute that income to a spouse or a minor child, or even if it potentially retains that income, then the donor is at risk of having that income attributed into their hands and taxed in their hands. So once again, as with corporatization, trusts are a very powerful tool, but they do require careful structuring and disciplined administration to ensure that the client receives the benefit that trusts can have in the estate.
I can maybe just add to that. So just back to your point about the funding through interest-free loans. As Candice mentioned, the interest not charged by the loan grantor is considered to be a donation to the trust. But this funding is then usually kept very low so that the interest income that you are forfeiting remains below that annual exemption donation limit, which was the 100,000 per individual per annum before. So that was a common, or that is still a common mechanism of funding these structures. So this increase in the donation exemption to 150,000 creates a bit of breathing space. We've calculated the monetary impact that this increase will have on the value of the interest-free loan that an individual can now make before having to pay donations tax. Previously, at the current published interest rates, individuals could only provide interest-free funding of roughly 1.2 million per person to the trust structure. This will now increase to roughly 1.8 million per person. So that's 3.6 million for a married couple, which is a significant increase. So this might shift some individuals away from equity funding if it's not necessary, because equity funding sometimes has to have some sort of growth attached to it, to interest-free loans. So I would suggest getting in touch with one of our consultants to see if your specific estate plan could perhaps benefit from this.
I think Tanya and Candice, we should also take into consideration that there's been some changes to 7C that has an impact on the funding of offshore trusts. So in the past, we were only concerned about Section 31 when we looked at funding an offshore trust by way of a loan, and your interest rate only had to be at arm's length rate. But since January last year, there was a change where 7C now also applies to funding of offshore trust by way of loans. And that has resulted in the official rate also being applicable to loans to offshore trusts. So I think it's important for clients to just revisit that with their advisors and just reassess the funding mechanisms and see, that it's all in order.
Thank you, Francois. Tanya, Candice, also for your contributions. I think the important consideration is always to whether it is indeed required to establish a trust or not. And I think as soon as that is determined, as you alluded to, all of you alluded to, it's the funding mechanism is also very important to take into consideration, because whatever funding mechanism you do make use of, they can have a significant effect ultimately, especially over time if you take the impact of 7C into consideration. Francois, we've touched on it earlier, where South African trusts make distributions to offshore beneficiary trusts. Many clients and advisors also need to think about the added complexity when South African trusts have non-resident beneficiaries. So from a practical perspective, Francois, what are the biggest lessons for advisors and clients when planning for non-resident beneficiaries of South African trusts?
Andre, I think many of our clients have children or family members living abroad. So therefore, it's become quite an important consideration, and we shouldn't lose sight of the fact that South African trusts are still prohibited by exchange control regulations to own offshore assets. So where naturally you'd be inclined to bequeath assets to a local trust, because that obviously fits into the estate planning strategy. But when we have offshore assets, we cannot bequeath that to a South African trust. You need Reserve Bank approval for that. In the past, we experienced that SARB will give approval for bequests to a testamentary trust, but lately we've even seen that to become very difficult. So I think clients should just be very careful in planning bequests to South African trusts. And ultimately, we must realize that if you bequeath to a South African trust, especially even South African assets, the beneficiary may be non-resident by the time they want to access the assets in the trust. And we need to think about how that process is going to work. So it's quite interesting to note that in October last year, there was an exchange control circular directing the authorized dealers they're allowed to make distributions or allow distributions from local inter vivos trusts and testamentary trusts, but only to non-resident beneficiaries, as we've alluded to, when you do a distribution from a South African trust and offshore trust. But where if the distribution is made to an individual, they must be a non-tax resident of South Africa. And if that taxpayer has not been registered, you need a manual letter of compliance. If they are still in the tax base, then you need the tax compliance certificate. So I think it's important for clients to just take that into consideration. I think on offshore assets, you want to bequeath to an offshore trust. If you don't have an offshore trust, you may consider establishing something like a freezer trust, which is an offshore trust that remains dormant until it is capitalized by way of the bequest. And where you do bequeath assets to a South African trust, especially South African assets, you need to just think about how that physical payment is going to happen to the non-resident beneficiary. And then, as I've said, since last year, there's some additional requirements that you need to meet from a SARS perspective before you can actually make that payment to the non-resident beneficiary.
Thanks for your inputs, Francois. I think what's very evident from our discussion is that it's not always as simple as setting up a trust and a corporate structure. There's various practical considerations that one need to take into account. And as you've mentioned earlier, you need the expert guidance on that. One of these many factors that people tend to forget sometimes is that as part of a structure, you also have to deal with the compliance and the regulatory frameworks. So shifting a bit to the regulatory landscape, I think South Africa has made massive strides in the compliance over the past few years, with enforcement and oversight, becoming far more rigorous than in the past. Candace, with FIC stepping up the enforcement, what should clients and advisors be aware of in terms of the compliance requirements and then also the reporting obligations in order to avoid penalties in the coming financial year?
Yeah, Andre, you are absolutely right. Compliance has been a hot topic since we, were placed on the grey list, and even after being removed from the grey list, we are still talking about compliance, and I don't think that we're going to stop talking about compliance in the near future. So when the initial anti-money laundering legislation came out, then there was a high emphasis on trusts, and trustees then faced severe penalties for non-compliance. And in that regard, it was declaring their beneficial ownership to the master, where the trustees faced penalties of 10 million rand or even imprisonment up to a period of 5 years. And companies, for the most part, didn't have that burden on them so much. But with the new draft amendment bill, we've now seen that there's a proposal that companies also now get severe penalties for non-compliance and for declaring their beneficial ownership. So they themselves are now looking at potential fines of up to 10 million or 10% of their annual turnover, and then obviously possible deregistration. And in addition to that, now the potential introduction of lifestyle audits. So where you think that you are just posting an innocent picture of yourself next to a Ferrari, and someone gives a tip off, or there's a red flag saying that Ferrari doesn't actually match my income that I've declared, then you could potentially fall victim to a lifestyle audit. And it's the collaboration between the government authorities is going to be tremendous. I mean, we saw with SARS as well, they weren't even mentioned in the anti-money laundering legislation, and they jumped in and they said, you're not going to submit your returns until you've done your beneficial ownership submissions. So there's definitely going to be a big step up in compliance. And we saw it last year and we saw it coming. We said that no longer can estate planning and compliance and administration be done in isolation. All of these advisors are going to have to work together to ensure that there is proper record keeping, reporting, governance, ongoing monitoring. All of that is essential to ensure that clients' estates and their estate planning isn't prejudiced just because of compliance being a technical afterthought. So it's definitely a critical point, and it is central to protecting both wealth and legacy in the current regulatory environment.
Candace, you've mentioned something interesting there, and it is very important. The fact that the era we are in today, it actually necessitates collaboration between your advisors. So that's definitely something that one also need to keep in mind. Francois, as part of this, one also need to keep the international compliance landscape, into consideration or keep that in mind. With increased global reporting standards like the CRS and automatic exchange of information, it's becoming more important than ever before for clients, and also the advisors to stay on top of your compliance internationally as well. From a practical standpoint, what's your view and what steps should clients and advisors take to ensure compliance, when holding assets offshore? And how does this by any way have an impact on your structuring decisions?
I think most important is for clients and their advisors to understand how the CRS reporting framework will apply to the structure that they're considering or that they've implemented. I think the worst case scenario is where you've got a mismatch on what is reported and it doesn't correlate with the actual information declared through the various channels. And that will result in quite an uncomfortable situation and quite a cumbersome process to clean up. So I think, in the old days, we used to just consider the fiduciary planning behind it, and then the tax treatment of the structure was quite important. But nowadays, I think there's a third pillar that one needs to consider, and that is how it will be treated from a CRS perspective. What will be reported to whom, and sometimes it's something simple like you used to appoint a protector to an offshore trust. Nowadays, it will result in information being reported to the tax authorities in that country where the protector is resident. And you may want to think if that is a desirable outcome, especially for the protector. So I think the world has become a small place in terms of just what information gets shared to whom. And I think it also applies to crypto assets. We've got the crypto asset reporting framework that's been developed by the OECD. We've signed up to that, and that information exchanges will become operational in 27. So even on the crypto assets, I think one should accept and realize that there will be information sharing going on, and one should be prepared for that.
Francois, without any doubt, compliance and enforcement are now definitely central to the financial planning landscape, and that's something one need to keep in the back of your head whilst busy planning for yourself, but also for your clients. Tanya, perhaps on a lighter note, a moment that caught everyone's eye this year is that the SARS Commissioner received a standing ovation at the National Assembly. Why do you think this recognition was significant?
Well, SARS has definitely turned a corner, and I believe they're back to their previous strength of 16, 17 years ago. So for one, they are ahead of mid-year collection projections. They've managed to invest in artificial intelligence and benchmarking tools, and they've picked up on many non-compliant taxpayers. So they really are doing well. The negative, unfortunately, is that they often disregard the suspension of payments. So they sometimes take funds from accounts without any remedy, therefore actually infringing on taxpayer rights. But there's recently been 2 court cases where the taxpayers' rights were preserved. The most recent one was Ferreira versus SARS, where the businessman disputed an additional assessment of 531 million. So the matter was heading to the tax court, and he requested suspension of payment and even offered security, which included a pledge of shares valued over 1 billion, which was completely fair, but SARS refused the suspension twice. They cited the risk of recovery, even though they admitted that the security's high value was high enough. So the good news is in February this year, just a month ago, the High Court sided with the businessman and said that there was no rational link between SARS's concerns and the specific facts in this case. So that was a relief and encouraging to see.
Yeah, indeed, Tanya. I see that we are almost running out of time. Perhaps to close off from our side, Francois, you've, in your introduction, mentioned that overall, I think the outlook seems to be quite positive. And I would like to get some closing remarks from our panelists. Francois, I'll throw the ball to you first. What's your, and the rest of the panel as well, perhaps a few closing remarks from your side?
Andrew, I think, yeah, for once, or maybe for a change, a very positive message about the budget. And I think it presents opportunities for South Africans. And I think there are advantages to be had, but in order to benefit from that, to make sure that, you know, that you actually do get that benefit, one should structure properly. And, you know, we've seen it many times in business transactions, in investments. You know, often the opportunity is there, people make use of the opportunity, and then afterwards we think about, okay, but how do we plan for this? So I think that's the message for me, is very exciting opportunities, but make sure that you don't leave the planning for last.
Yeah, no, Francois, I concur, and like Tanya said as well, with SARS bringing in AI into their audits, the places to hide is getting fewer and fewer and fewer. So the time is, well, the onus actually is on us to ensure that our clients plan with the end in mind, and that they structure correctly from the start to avoid any unnecessary tax consequences at a later stage.
Yes, I think, Andre, also from my side, as Francois mentioned earlier, definitely feels like we can breathe again after a couple of very aggressive budgets in the last couple of years. So I do believe the GNU partners have had a lot more to say in this budget compared to the 2025 chaos. But we also got lucky with higher resource prices last year, which gave Treasury the opportunity to pass through some relief to taxpayers. Whether or not this U-turn is sustainable will be the big question. So we will have to see next year, but for now, we need to jump onto the opportunities.
Thanks for the closing remarks to the panel. I don't see any questions in the Q&A. So I think with that, thank you to all our panelists for sharing.
Andre, yeah, I think there was one. There's one from Dylan.
Okay.
He says, it's definitely a positive budget this year. What are the chances that SARS will allow your company to deregister for VAT if your company falls below the new VAT threshold? So they shouldn't have a problem. There is a section in the VAT that allows you to voluntarily deregister. So you just need to prove to them that 12 months worth of taxable supplies are below that threshold. Then you can deregister voluntarily.
Well, thanks for that question, Tanya. Thanks for bringing that to my attention. I almost missed that one, and thanks for the answer as well. I don't see any additional questions. So yeah, thank you to our panelists for sharing your insights today. You highlighted definitely both the opportunities, but also the risks and the challenges that one need to keep in mind. I think we've covered a wide range of topics, and it's clear that staying informed and proactive is key to protecting client interest and navigating the year ahead successfully. So thank you to our panelists again. Thank you for our audience for joining us this afternoon. We hope you leave today's session feeling better equipped to apply these insights also in your own planning and advisory work. Please feel free, if you do have any questions or require advice or assistance from our side, you're welcome to reach out to us. You can send us an email. You can find our contact details on our website, which is www.phinc.co.za. Yeah, so that's for us to conclude. On behalf of everyone here, thank you for your time. Thank you for joining us. Have a great afternoon and goodbye.